Hi, this is Paul Bosley from Business Finance Depot, and this is the second part of a three-part video series. In this part, we're going to talk about how to fill out a personal financial statement. So as you're watching this video, you'll be able to see the actual form itself, and I'll be directing you to certain parts of the form. First of all, even if you're the only person in the family that's going to be on the business itself, it's a joint form for people that are married. I can't stress that enough. So both husband and wife are listed at the top, and both of you eventually are going to sign on page 3 at the end. So it's a joint form. Even though there's only one person on the loan, it doesn't mean if you're filling out a joint personal financial statement that both people will have to be on the loan. But if you're married, you both have to be on the top of the form. Second, when we go to the asset column and you look on the column on the left, the cash, the savings, the marketable securities, and the IRA and retirement account, that's self-explanatory. You're just going to take your most recent balance and you're going to write it down in total. When you get to the life insurance is only for your whole life policy, not a term policy, only a whole life policy. If you don't have a whole life policy and you have a term policy or you have no insurance at all, obviously you write 0 or you don't write anything at all in there. Your real estate, I would suggest that what you do would go out on your favorite real estate website and just look at what your real estate is worth today, and you put that total down, and that will be the value that you put in real estate. And it's a total value. So if you own more than one home, then what you should do is total the two values on what they're worth today into that column. Other property is really something that's tangible that you own, that's in your house, things like jewelry, furniture, things that are valuable. So you would total that up. And then finally, the last column, other assets, is very important because in many cases, if you put money into the business already and you've maybe paid a franchise fee as a deposit, you've taken money out of your liquid assets, out of your cash, and now you've invested it already in the franchise, which is an asset. It's franchise rights. If you put a deposit down to a landlord, for instance, that's a deposit. So those other assets would be totaled into that other asset column. If you have another business now, the way that you should record the value of that business is by looking at your most recent balance sheet and putting down whatever it says for owner's equity. Don't put down what you would sell it for today. Put it down what it shows on your balance sheet, and you would add that to whatever your net income is, and that's what the value of the business is. That would also go into other assets. So other assets, again, could either be the value of a business that you have today, or it could be money, or it could be money that you put into the business that you're going to start. So once you total that column, let's just say you have a total of $1 million in assets. You would take that $1 million total and put it in the total on the bottom column on the right so that the totals have the same dollar amount. Next, you go to your liabilities. How much do you owe on your home? You put that into your mortgages. If you have more than one mortgage, how much do you own on your home's total? How much do you owe on your cars? You put that as a total. How much do you owe on credit cards? How much, that again, would be a total. So then when you total your liabilities, the difference between your total liabilities and your total assets is your net worth. So you subtract your assets, you subtract your liabilities from your assets, and the difference is your net worth. That's the most important number on this form, because that's what the lenders look at, what your net worth is. So once you do that, the next section down on page 1 is your income. That's incredibly important that you write down whether you have W-2 income, whether you have other income. It might be retirement money that you have coming in. It might be from investments. But you identify what the other income is, because lenders want to see that you have income, especially they want to see if you have a secondary form of income in addition to the money that you're going to pull out of the business that you're going to open up. So section 1, your other income, is very important, just like your net worth is important. Those are the two things on this form that the lenders are really keying in on. Page 2 is pretty self-explanatory. You just want to really be specific, especially when you get to Section 5 on other assets, because you could be writing down stuff like furniture, jewelry, money that you're putting into your retirement account, into your new business, or money that you've already got invested in another company that's open. So Section 5 tends to get a little crowded. The rest of the sections on page 2 are very self-explanatory. And then finally on page 3, if you're married again, both you and your spouse have to sign it and date the form. Thank you for listening to this video. Again, this is Paul Bosley, the founder of Business Finance Depot, and we look forward to serving you in the future.